Let's bring on our next speaker here. I see him backstage. Matt Timpane, who's a senior market strategist at Schaeffer's Investment Research.
Woo!
At Chapter 6, we are making headway on the April Benzinga boot camp. We have already come to the second to last chapter of the day. Matt, how are we doing?
Not too bad. How about yourself, Spencer?
Oh, we're just hanging out, watching charts, looking at markets, doing what we do.
Nice.
Yeah. Well, what are you seeing out there? Anything interest you today?
Yeah, I mean, quite the little bit of a rally there on the rates kind of falling. You kind of got that tech rally going a little bit here, but not sure if it's sustainable. We're still seeing weakness, in many other areas. As you mentioned, the banks. That's something we'll actually highlight even during the presentation of some trades that we've made and one that we're even still kind of in.
All right, so we're talking short-term option strategies for volatile markets. Mr. Timpane, the floor is yours.
All right, wonderful. All right, so my name is Matthew Timpane. As you said, I'm a chartered market technician, the senior market strategist over at Schaeffer's Investment Research. We're based out of Cincinnati, Ohio. We have been in business providing option education and trade recommendations and research for now over 40 years to retail and institutional clients. So a little background just quickly on me, former portfolio manager and partner at a registered investment advisory firm. When we decided to sell the firm, I moved over to Schaeffer's as it was not only just a great team to join, but my own curiosities, right? I thought, I was mostly in equities before, and I thought options were definitely underutilized by a lot of people. I also saw the power of the do-it-yourself investors, like a lot of yourselves. Not everybody needs help doing a financial plan. They can do it themselves. Not everybody needs help managing their own portfolios. They can do it themselves. It's right for some people, and doing it yourself is right for some people. So I wanted to really kind of take that opportunity to jump in to the sector and just deep dive into options. So and help people out while I could. So for today, we're going to talk about short-term option strategies for volatile markets. Some will be a little bit pre-volatility when you have expectations. Some are going to be able to execute while we have the volatility in the market. So what is the nature of volatility? Volatility, basic compression leads to expansion and vice versa. It's an impulse consolidation, impulse type of move. Think about it like a coiled spring. What it will do is, you will compress and then the pressure will release and explode. Another great way I like to look at this as, maybe consecutive lines of dying stars. You have a star that's mass is imploding on itself and continues to pressurizes before it eventually explodes higher. That is how the nature of volatility works, whether it's in indexes, single stocks, doesn't matter, bonds, anything you can trade out there, crypto. This is how volatility works. And then just a general concept, options are generally lowest during consolidation phases with volatility. So this is usually the optimal time to get into positions. But, as you can see, sometimes we have prolonged volatility events. We had it in 2020. We recently kind of had it. How do you play those? So there is some ideas for those as well. So we'll go over them. So this is the VIX chart to kind of just highlight that compression and that coil, how that works. You will see, every time we kind of have this, spike in volatility, we often get, short-term market bottoms or we're near it. So levels that I just have marked on my chart are the 30 and the 25 level. The 30 level is kind of the danger zone when it pushes above. You can also kind of use that on the VXN as well if you track the NASDAQ volatility. And then right now I have the 25 level marked on this because as it's been able to hold underneath that 25 level, we've been able to get some bullish trades going. So these are kind of my markers. It's not really, abundant technical analysis on the VIX for me. It's more about kind of levels of where we are. I also like to monitor the 10-day rate of change. You can make it 14-day too if you want, but moves typically above 50 also predate potential short-term market bottoms. So it's another way to kind of gauge where you are within the market cycle and how you can use volatility to your advantage. But one thing that you're going up against, as we're in volatile markets, this never changes, is time decay. So if you're a long option buyer, premium buyer, you're constantly battling, time decay. Theta operates in a nonlinear fashion, and as you approach expiration, that just only increases. So volatile markets only really compound on the effect as implied volatility expands in the markets, making options more expensive as they embed more time premium into those contracts during those volatile moments. So it's also, you're at greater risk. So now you're at a risk of just implied volatility imploding, but you're also going up against possibly an expiring contract, which would only make matters worse for you. So some strategies that you can use for volatility. Like I said, it's going to be a mix of some pre-volatility with the expectations of a volatile move, and trades that you can use when the markets are already pricing in some volatility. So we have directional at the money type of trades, directional deep in the money. We have straddles, we have pair trades, and then we have credit and debit spreads as well. I didn't include selling other premium strategies because these are really kind of the simplest, and iron condors are more for neutral type strategies, even though you can manage them accordingly if you needed to. So directional at the money. Typically what we're doing with this is we're getting really aggressive at our firm. We're looking for returns that are about 200% on these types of trades. We have strong directional conviction. You can do this in a multitude of ways. I'm going to highlight the way that you can play it with volatility, but there's also a way to play it with low volatility in trending markets. So to begin with, at a potential pullback moment, say the S&P 500 is, kind of close to breaking down on its longer term trend line. It's kind of hugging it. Maybe it already kind of broke it, but it's kind of inching back up. These are the type of times, where they're possibly below their short-term moving averages, like the 10 and the 20-day moving. You haven't fully broken that 50 or that 100-day moving average yet. These are the times to take those directional bets if you want to get short the market. On the long side, it would be, sitting in like a flag type pattern, waiting for that potential breakout. You're expecting a volatility expansion, and volatility goes both ways. So, when you're looking at an options market. So when you have fast expanding volatility, typically the trade can be moving to the upside or the downside strongly. So during bull cycles, like I said, this works too. It's best trending. The best recent example, if you want to see one, is just go look at Bristol Myers. I think we just collected a 186 or 87% return on that, and it was just a nice trending chart. So for our example on this was a little bit further back. We were expecting volatility. The trade date we entered was actually December 21st, 2021. Total profit was 161%. And on the second half, we actually achieved that 200% of the trade. So what we were seeing in Mosaic, right? It was breaking out of these kind of downtrend lines. You already had one aggressive move. It came back down below those prior highs, and it was back in a channel. It actually came down, tested what is the 200-day moving average down here. I apologize, I didn't put it on the chart. And it was the 50% year-to-date level. So it was able to kind of find support there. So on this breakout above this trend line right here, we were able to get into this position. And we had the expectation that if we broke above these prior highs, that this thing could really get moving. It had a volatility scorecard, which is something we have at Schaeffer's, of 87. It's on our website, so you can always go there and look at it. What that is we're expecting a bigger move in the options than they're priced on a relative basis among the option universe. So we even rank it against its peers, all optional securities. We had a fairly low IV rank. It was coming in around the 23rd percentile. And there's a big buyback program that was announced in August of 21, $1 billion, which was about 8% of the shares outstanding. So we had catalysts in our favor. As you can see, it wasn't the quickest and fastest trade for us. It came back, tested support multiple times. This is why we decided to buy 60 days on this versus a typical 30-day trade usually we do on this. And good thing we did. We were able to find support again. We took about 100% profit up here, a little bit more. It faded back, and the only reason why we could stay in that trade, we would have probably been stopped out if we didn't take profits, was because it could hold this trend line here, and we weren't down on the option at that time because we took those profits. So then we held it right into expiration, in the February expiration, and we achieved our targets of $45. After that is basically your classic example of a trending breakout if you want to see it. You find a low implied volatility standpoint, and on these big breakouts, sometimes you can get a nice tight consolidation trending type of pattern like that. It's something I missed on Mosaic, but we've hit it on many others. The next one that you can actually use during a high IV environment, doesn't necessarily need to be, but you have, it's directional in the money. So we're looking at deltas on here of around 70 delta. It's momentum driven. You have strong directional conviction. Usually you're playing this on a breakout, so the breakout's occurring as it's happened or is happening. And you can play this during the pullbacks or even early innings of a rally when implied volatility is still high, because you're protecting against volatility implosions by buying more in the money, higher deltas, and you can hopefully decrease some of that time premium that's going to come out of it when the implied volatility is implode. So to set this trade up, I just have a chart up here of the 10-year yield minus twos in blue. I have the KBE in green, and then I have the 10-year yield itself in red here. What we were seeing was, investors were extremely bullish on banks because the 10-year yield was rising. But what a lot of people weren't watching was the yield curve was absolutely cratering. So typically, that's not a good sign for banks, as the long-term versus the short-term lending, that starts kind of compressing and narrowing those net interest margins that they take on interest. So that's going to hurt revenue. Financials were the most overloved and hype group really coming into 2022, and we're actually somewhat being validated by sector outperformance. But the trade that we took was Bank of America for this example, and it was actually in the red. Call buyers couldn't get enough of it. The 10-day call put volume for buy to open data was over 3.0. There was an uptick in short interest recently coming off of a multi-year low. Could mean some smart shorts were coming into the trade. And then again, recent Fed talk at the time was really narrowing that short long-term interest rate spread. We thought we could see some margin pressures coming up here as earnings were approaching. It was also a declining 40-day moving average, and we were betting against this trend line, which also had peak call level above at 45. So you had multiple factors that could be resistance for us. So we took it on, I believe it was 2.8, somewhere around there, 323. And, we took it on this breakdown lower. Now it traded up against that 40-day, capped it for us so we could stay in this trade. And then we were able to finally get that eventual breakdown, and we were able to go to our targets at $40. Had some other factors like a good volatility scorecard as well, 87. So, even though options were a little bit higher priced, we were able to get into this and have expectations that we're going to get a bigger move than expected. Another type of strategy that we do like to use as well are straddles. Now, what you're going to do here is you're looking for volatility of a large move on the horizon. And it's a way to just profit from volatility. And what it is we're really looking for underpriced relative to the potential move in the market. And you're buying a call and a put of the same security, same expiration. So these are really good for volatile markets when, we've rebounded or you think we might go for a tumble in the markets. When we've rebounded, you see some, bull flags, some things that look extremely bullish, but you're still worried about the overall market. But you think you could have a large move in the security. This is a good way to play it. Even if it's to the upside, yeah, you are limiting maybe some potential, but you're also, hedging your bet that if maybe it was a fake out move and you're going to have a further downside move like we just did, you're going to be able to hit this as well. So that's kind of a good way to play straddles. Now, one of the biggest things with straddles is kind of looking for that compression and volatility. You'll see we entered this trade on February 8th for about $1.18. And, you saw the Bollinger Bands have a tight compression here. It just kind of popped out and came back down and tested when we put this on. and it was in a symmetrical triangle pattern. What you're really kind of looking for are those symmetrical triangle patterns, wedges, or like base kind of plays where you can, bet to the upside or the downside, and you're probably going to get a big move. Options were actually fairly, well priced, even though we were seeing some, pressures starting in the markets. Options were actually priced in the 16th percentile over the past 52 weeks at the time. We also had a macro catalyst coming up. CPI data was going to come out. And, as you realized, the macro trading environment had been very volatile. So we figured that it could have a dramatic effect possibly on the metals market, which that's exactly kind of what happened for us here in this trade. Gold, Barrick Gold was also set to report earnings on the 16th of February. So any surprises from that event could have also sparked volatility of the shares. So what you do typically is you just buy past that event so you can capture those moves from that. So this is one way that you can play volatility pre or even after a big volatile type of move to protect yourself from possible, directional bias that you may have in the market, but maybe you want to still hedge it off a little bit. There is another way that we do like to also kind of look at playing it maybe a little bit more of a conservative manner when we are trading during volatile markets, looking at pairs trading. So why do we do a pairs trade? Well, we're uncertain of market direction or sector direction. It allows you to profit from the volatility, and what you're doing is you're just buying a call and a put on a security within a specific sector. And one will be a bullish take, obviously, buying the call, and one will be a bearish take, buying the put. So you're really looking for an outperformer versus an underperformer within the sector. This is more of a conservative approach than possibly, say, buying the straddle. This would be more conservative than making your directional bets. Hedge funds have done this for years. Yes, there's been years of underperformance with pairs trading, long short strategies by hedge funds, but there's also been years of outperformance. So, it's all about kind of what kind of market environment you're in, but it is a decent way to trade volatile markets. Now, you can't expect gains of 100% or 200% when you're pairs trading, because what you're trying to do is you're trying to hedge your bets. So you're really, it'd be nice if you hit the 100%, but you're really looking for anything above 50% on gains there. And you're taking, these positions off at, say, risking minus 25% on the total trade. So again, the backdrop, you have the 10-year minus the 2-year yield spread. You have the KBE banking sector, and you have the 10-year yield. So we saw these divergences happening. We know that, banks typically don't do well with those divergences, even though investors were pretty bullish. So it's a bank trade that we did long short here. And Wells Fargo was actually a trade I had been in prior. I entered it back in 2021 from the long side. It was in one of our directional products. And, I got 100% return on the first 50%. And I was going to kind of add on to that in this trade here because we were still in it. You can see Wells Fargo was kind of just managing a nice little uptrend. The first time I entered it was back in 2021. So when we enter here on this pair trade, because I was starting to get a little bit worried about financials and banks, we entered here on this plus 10% year-to-date level, which we like to call kind of like blind levels. We look at everything from plus 10%, plus 50%, 100%, 20%. We look at market cap levels. These things aren't popping out on your charts, but sometimes you find these levels to be support and resistance, much like I was talking about how peak calls and peak puts can be support or resistance. And then breakthroughs through those, just like the peak calls and those can be big moves. So we purchased this here, like I said, as it was kind of breaking back up off of the support range and back up through the pre-COVID levels on February 8th. Would have been nice to obviously manage risk up here, but the overall trade wasn't that positive at the time. But the trade that we didn't like to go with it was Citigroup. Citigroup, was in a prolonged kind of downtrend here. it was acting different than the other banks, much like Bank of America. It was still trading below its 10% year-to-date level and finding resistance there, finding resistance at the downtrend line, and then also the 160-day moving average, which had been significant in the past, and we had some quantitative analysis on that, telling us that. So we were able to enter into the put position on Citigroup there, and like as I said, would have been nice to manage up here, but we were probably only plus 25% on the overall trade. Luckily for us, we got that resistance, and with that yield curve inversion continuing to flatten and to go to inversion, as it continued to fall, Citigroup went right with it. Another big thing about Citigroup that I was looking at was, it also had an overly bullish outtake by analysts. Analysts had, I think it was 4 strong buys, 15 buys, and 8 holds. There was no sells whatsoever on the stock, and it had a pretty good volatility scorecard. But the big catalyst to me was it's the bank with the most international exposure, and they have a decent amount of Russian exposure, and that's when Ukraine and Russia tensions were starting to heat up. The war hadn't broken out yet, but as a way to kind of hedge against that possibility, Citigroup looked like the best logical type of trade here from the short side for this pair trade. And as you can see, it kind of worked out. What we did was we took profits down here near this lower trend line, and it went against us. It was around 50%. I think I only snuck out with some slippage around 48.5% on the total trade. But now it's working once again into our favor, back below actually that lower trend line. So we could see even further downside from here. And we still have a month on this trade. So we'll be managing it accordingly. If we get back above the trend line, we might get out of it. But right now you're kind of just letting these things work. Let the convexity work for you with this option now easily over 200% on it. On the pair trade, on that leg of the pair trade. On the other side, that's obviously at like a minus 90% loss. So that's how you kind of got to look at it when you're doing pairs trade is from a whole trade perspective. And then finally, we have credit or debit spreads. You're going to have a directional bias. Your directional bias might not be as strong of conviction, which is a good time for highly volatile markets when you're playing with those high implied volatilities. But you can profit from a wide range of outcomes. It doesn't need to be a winner to the upside. It can go sideways, and it can even actually slightly go against you, and you can still profit from this. You also have capped losses. So if it goes totally against you, you're capped out at what you paid, the differential between what you collected on your premium and your strike distance. So, and then also theta, time decay, it is your friend. So it's working for you in this capacity. And those volatility implosions now are working for you instead of being a long premium buyer. So wanted to kind of show you February's versus March's trade, because March's was a lot cleaner. February's trade is, we were coming down to those October 2020 lows. And as you can see, I put the spread on right on that day, right at that support level, and it kind of immediately went against me. We sold the March 397, 395 put strike. I believe we were able to fill at our average fills, because we take a time limit for our subscribers to get into the position, was 37.5 cents for an average VWAP score on that, or VWAP score on that. And the reason why we did this was October 2020 lows. It was holding plus 10% year over year level. We were, selling below the 400 peak put level for March. And we saw that the buy to open 10-day put call ratio was in the 100th percentile. So retail option traders that are aggressive, we're never more bearish on the markets. We like to take a contrarian aspect to that when we're looking at this. And then, the IV rank was in the 91st percentile. So options were extremely expensive. But again, one final thing that we do sometimes use with this, I like to at least, is our volatility scorecard that you can find on our website with some of the highest scores on there. But this one had a mundane 40 score. So we weren't really expecting that much more of a large move relative to where options were priced kind of gives you an indication that even if you are going to head down and maybe be wrong on the direction of this trade, that you might not hit your call strike or your put strike there at 397. It would likely hold at least that 400 strike. But as you can see, we didn't even get there. We tested 415 areas that week, and then I think we rallied a little bit into expiration, with it expiring worthless. So it's a way that you can just see that you don't have to exactly be right. You can still play this and still collect some nice premium. That was about, I think, 18% on the trade. And that is it for me today. Thank you for your time. We'd love to chat with you about your options trading. We have a bunch of free stuff at Schaeffer's Investment Research for you to look at. Unique takes on the options market that nobody else is really putting out there. With put call ratios and other aspects and quantitative analysis on certain technical indicators. Otherwise, there's Education 101 there too to learn more. So, and give us a follow on Twitter.
There you go. Thank you, Matthew, for joining us on the Benzinga Bootcamp today. Go ahead and smash the like for Matthew. That was some great content. Matthew, enjoy the rest of your day.
Yeah, you too. Have a good one.